Well, when you look at all of the bad news that's out there, I mean, I think it's not a question of why the market is down, it's why it's not down further. I mean, think about it. Saudi Arabia, Chinese slowdown, Fed raising rates, the midterms. Looking at that, you can say, of course, the market's down, but it doesn't seem to be dropping. We're still in normal volatility. So in the absence of further downward momentum, I think this just continues to be noise.
But the companies themselves are coming out, and even the companies that are reporting these gangbuster earnings, they're beating expectations, maybe lifting guidance. I saw this with iRobot yesterday, lifting fourth quarter guidance in spite of the tariffs. And yet they had their stock going up right after they reported that. But so many of these companies don't. What are you reading in the tea leaves here, Talley?
So look, I think there's very good reason for stocks to be selling off here, and investors are realizing and recognizing the gathering headwinds to U.S. growth, whether it's the trade wars slowing U.S. exports or the strength of the dollar having a similar effect, and also on slowing earnings growth as we head into the second half, rising interest rates and wider corporate credit spreads. And might I also mention elevated oil prices. All of these things are brakes on growth in the U.S.
So why do you like growth stocks, Talley? I mean, something doesn't make sense to me. This doesn't equate.
So it might seem paradoxical, but when economic growth is slowing, you can't get it in an abundant fashion. You want to favor those companies that provide the fastest sales and earnings growth rates. And that's exactly why I think this remains a growth market from an equity perspective.
That notion, though, of reaching for idiosyncratic growth stocks, namely technology, Talley, that hasn't really worked. I mean, we're seeing a market where technology is being sold off the hardest. It isn't people looking for that idiosyncratic growth story anymore. There seems to be some doubt surrounding that. So why would you go into the sector, particularly when you have, for instance, just as an example, the FANG stocks, right? We lost some of them in terms of their 52-week highs in late summer, and we haven't looked back.
So you're talking about a one-month dynamic, and I'm talking about chaos that creates opportunities for the next couple of years. And that's kind of where I am. If you think the expansion continues, tech stocks can help extend the cycle here and give us some of the growth that we're looking for.
Okay, and so CNBC used Ken's show to take a look at which stocks do really well during volatility. And they said steady stocks with big dividends and consistent revenue like United Health, Chevron, Verizon. What do you like, Brad?
I tend to like healthcare. I tend to like real estate. I'm a little concerned about energy. But I think Talley's right. Growth over time is the place to be. But it's got to be covered growth. It's got to be reliable growth. And you get that in a sector like healthcare. You get that in a sector, where you can actually see where the money's coming from. Tech, it's all about growth. I think you need to go back a little bit to actual real dividend generating growth. And that's where I am.